In this video, I'm going to talk about generally accepted accounting principles. By now, you must be familiar with the four key accounting terms, which are assets, liabilities, incomes, and expenses. The next step is to learn how the records are going to be prepared for various transactions which fall into these four categories. But before we learn the process of recording, classifying, and summarizing, we need to agree upon certain ground rules. Generally accepted accounting principles, or in short called GAPs, are the ground rules for preparing the financial statements. Let's look at these generally accepted accounting principles. I'm going to discuss about 10 of these. There are a few more. If you look at different textbooks, you have different lists, but everybody would agree on these accounting principles. And in this video, I'm going to address 5 of these, and then the remaining 5 will be addressed in the following video. The first generally accepted accounting principle is called the principle of business entity, or also referred to as business entity concept. This principle means that the owners of the business and the business itself, they are not the same. We have to create a clear distinction between owners' transactions and businesses' transactions. You cannot mix the two. The business is a separate legal entity. The business is a separate legal entity, and hence the name business entity principle. The business has its own entity, so you should not mix it up with the transactions, the personal transactions of the owner. And we saw a proof of this in the accounting equation. The accounting equation is assets equals liabilities. And if you look into more details on the liability side, you have capital and you have the rest of liabilities. I'm just writing this to illustrate to you how owners are kept separate from the business. Now, what is capital? The capital is the contribution that is made by shareholders. Shareholders' funds. Who is shareholder? Shareholder is the owner, the part owner of the business. Therefore, what is happening here is in the business, we are creating a new liability. The company has to return this money to the owner. So for a business unit, let's say this is a business, the owners which give capital to the business has to return this capital to the owner at some point in time. So we create owner's money we treat owner's money as a liability for the business. That is what entity concept of the business means. Let me give you a quick exhibit of this as well. We looked at Reliance Industry Limited's balance sheet. This is the equity side of the balance sheet, and I told you that this equity is what represents shareholders' funds. Shareholders' funds, the money brought in by shareholders, and there is a head called other equity, which is essentially the profits which are accumulated over a period of time. This section has the reserves of profit that you accumulate over a period of time. Both of these are owed by the business to the owner of the business. So there you go. That is the business entity concept. This is the most important concept of all. Most of the times when we go to the process, learning the process of recording, classifying, and summarizing the transactions, you will get confused. You will try to mix up the transactions of individuals and business. You always have to, whenever you're writing in the books of accounts, you have to think you are business. You're not writing in your personal books. You're writing in business's books. So if business was a real person, what would it write in its books of accounts? More on that when we go to the process of recording. Another example of the business entity concept is, this is again an excerpt from the annual report of Reliance Industries. You have on page number 220, you can see the remuneration of managing director, the whole time directors. So this is, Mr. Mukesh Ambani is the owner, the promoter, and the owner or promoter gets paid by the business as well. So not only that the owner supplies capital to the business and earns profits on that capital, in addition to that, owner works for the business. The owner is also employed by the business, and the owner can demand, or the company can pay a remuneration for the day-to-day regular services of the owner as well. So that's another proof or an exhibit to tell you how companies treat owners separate. Although, actually the company will not have an existence if the owners do not exist. But in the eyes of law, the company is an artificial legal person. So you have to treat it like that. You have to keep the records of the company separate. Again, another detailed exhibit. You can go to page number 227 in the annual report, and you can see that the promoters' shareholding is 46% in the company. Then there is public shareholding. So all these people are the owners of the business, and the business reports as to who is it owned by as well, just to create that distinction that we are owned by these different investors. All these people are owners, but they are separate from the business. The business owes to all these different categories of people. Okay, that was the first principle. Let's move on to another principle, which is called money measurement concept, or principle of money measurement. This is very simple. What it means is you can only record the transactions which can be expressed in terms of money. In the books of accounting, if you cannot express something in terms of money, if something does not have monetary value, it's not possible to record that in the books of accounts, right? So it's all about money. So there are things which can be important for the business. For example, the quality of product, right? Is it important for business? Yes, it is important. Does the sale depend upon the quality of the product? It does. But can you express the quality of product in money? Is there a transaction that happens in terms of the quality of the product? No, it does not happen. You can't express it in terms of money. The best thing that you can do is charge a higher price. And when you charge a higher price, that's taken care of in a sale transaction. The total amount of sale that you get, if for example you're going to be charging, instead of so if your cost is 100 and you're going to charge, let's say, 500 for it, because the quality of the product is very high, you put in a lot of resources, material into it, there are a lot of overheads there, and despite the competitor selling at 400, you are selling at 500. That reflects the quality or your perception of quality of the product. However, directly can we write in the balance sheet of the company that quality of the product is an asset for us, right? In general discussion, in common parlance, people talk like that. The biggest asset for our company is the quality of the product. But you have to create a distinction between the English language and the accounting language. In accounting language, assets have a very specific meaning. The quality of the product is not the asset. The asset is something on which you spend the money for a longer duration of time, and that specific asset helps you build capacity to generate more income over a period of time. And now we've learned a ground rule to add to it, which is you also have to you should be able to express this asset's value in terms of money. If you can't record it in the books of accounts. Similarly, you can talk about morale of employees. If the employees are not motivated, they'll not be productive, they'll not be efficient, they'll not contribute positively to the business, that is going to affect the internal functioning of the organization and also the output which organization delivers. However, can you express the morale of the employees in terms of money? Well, there is no transaction again that happens. Uh, you could pay them more. If you pay them more, maybe they'll be more motivated. But when you pay them more, their salaries go up. And you record that as an increased salary. That's it. But you do not write it down in the books of accounts as morale of employees. So do understand, you have to create a distinction between the qualitative aspects and the quantitative aspects. So you have to be very clear that the qualitative aspects of business, although they may have high importance and they do affect the output of an organization. However, the only things that you can record in the books of account are quantitative numbers, and also in terms of money. That is the money measurement principle for you. Let's talk about another principle, which is going concern. The principle of going concern. What does it mean? This means when a company is formed, an artificial legal person, the company, what is the age of the artificial legal person? For a real person, average age in India is what, 65? So for an artificial legal person, what is the average age? There is no limitation to the age of an artificial legal person. It is expected to continue till infinity. That is the purpose of creating a separate legal entity. If an individual owns the business, if you mix the two identities, you don't follow the entity principle, business entity principle, the individual dies, or if individual is sick, the business is sick or business dies, right? This individual has everything inside him. He knows what the business is about. He maintains all the relationships in the business. So everything is dependent upon him. But when you create a separate legal entity, then people may come and go. The promoters may sell off their shares to somebody else, and somebody else can come in and start running the company. But company will continue to exist. So that's the basic idea behind all these principles, in order to think differently about the company form of business. Okay, getting back to it, going concern concept says that the business is expected to continue for long meaning very long period of time, years and years. You don't expect companies to come to an end, unless of course they are inefficiently managed, they have to be shut down. But companies don't just die because people move out of these companies. So because of these reasons, there are certain, I'll show you exhibits as well to prove the point further, but you would notice that we discussed under liabilities, there were items called current liabilities. Current liabilities means these are the expenses that you have to pay, and they have become overdue. You did not pay them in time. Uh, One example of this is creditors. Creditors are your vendors. They ship you the raw materials, for example, and then they say within 3 months you have to pay us. That's a credit policy. So the policies of business are also based upon the going concern concept. The vendor believes or expects that the company is going to continue. The company is not coming to an end. The contrast of this would be a customer comes to your shop, you sell goods to him, and you say, please pay me immediately. You don't let the customer walk out without paying, right? You go to a supermarket, will they let you take the stuff and move out of the store without paying? No, they will not. But if you know that person personally, you have some relationship with him, then you can say, okay, can I pay you tomorrow? And he might agree because he knows where you live. He knows where you studied. Maybe you were friends for many years. because you have a personal equity, personal reputation with the person, he will allow you to pay you later. So there is a continuity. He can catch you after that. Now, here in this case, what is happening is the creditors are building a relationship with the company. The company is going to expect the company is expected to pay back in future because company is expected to exist in the future. An unknown customer coming to your shop, you do not know whether this person is going to come back to me. Maybe if you let this person go, you have no idea about who he is. But if he walks out of the store with a promise to pay you tomorrow, maybe he'll never come back. Maybe he'll get hit by a truck, unfortunately, and he never comes back. Who are you going to recover the money from? So, for all these reasons, the legal entities continue to exist. You get into a transaction with a company, not an individual, because the company is expected to continue. So, creditors extend you credit period, and under assets, you have current assets and you have debtors. Who are debtors? These are your customers. Again, these customers can also be companies. You can have different policies. For individuals, you will say only cash sales, there is no credit. But if there is another business which is purchasing from you, then you can say, okay, for businesses, we have a credit policy of 3 months. Even if the owner of the business sells the business to somebody else, in the books of accounts of the company, it will be written that this much amount is due to this company, and the regardless of who the owner is, who the manager is at that point in time, whether he changes or not, the books stay there. So your recovery is assured, your recovery is secured by this process. Okay, let's move on to an exhibit. So I just showed you that under the current assets you have trade receivables. These are your customers. These are your customers, and the total amount which Reliance Industries has to recover is 12,000 crores. These figures are in crores. Now, if these customers were going to run off, then you would never do the business. The Reliance Industry will go out of the business, right? Because, and possibly RIL does a lot of business with other businesses. So you expect those businesses to continue as well, and you have a credit policy. On the other side, you have under current liabilities, you have trade payables, and you have to pay to micro and small enterprises and some other micro and small enterprises. So there is a total of about 39,000 crores which Reliance Industries has to pay to other companies, and typically these are micro and small enterprises. So if the business was not expected to continue for long, all of this would not be possible. And business is expected to continue for long because of the previous principle, which was business entity principle. Owner's entity is separate from the business, and business has an eternal legal entity, and this business can be sued, this business can be transacted with independent of its owners. All right, let's go to another principle which is called accounting period concept. Now, what is accounting period? In the previous principle that we discussed, we said the business is expected to continue for a long period of time. It may not come to an end if everything financially goes well. Now, in order for various shareholders or let's say stakeholders, shareholders are only the investors. Stakeholders also include employees, government, customers, and all the rest of parties involved. In order for the stakeholders to understand if the business is going to exist in the future or not, these people need to know how well or if the business is doing well financially or not. Right? That is important. In the previous principle, we said business can continue for a long period of time regardless of, independent of the owners of the business, the management of the business, right? These people can change. However, if the business runs into financial difficulty, it'll close down, it'll shut down, and there are laws around that as well. And if there are frauds and so on, there can be legal cases against the company, and people will be penalized. The company will have to come to an end. You don't want that to happen. So all the stakeholders of the business, they need to have a clear picture of what is going on in the company. So they are not going to wait for company to come to an end and then look at it. Oh, what happened? What were the reasons? Right. So there needs to be regular checkpoints. There need to be regular milestones when you want to look at the company's financials. Okay, what is the revenue? What is the profit? Where is the money coming from? How much are you spending? Is there something wrong? What is going on in the various departments in the company? You want to know that periodically, right? So what you need to do is to divide the infinite life of a company into smaller pieces. And these pieces are called financial years. So we're going to divide the life of the company into financial year. So right now we are into financial year 2020-21. Then you will have 21-22, financial year 22-23, and so on. It will continue. Now, for each financial year, the companies have to prepare and submit their financial reports. An annual report has to be published by the public companies. Private companies do not have to disclose their financials publicly, but they still have to submit their financials with the registrar of companies, which is a regional body where companies are registered and companies supply their regular periodical information and updates. So all the companies have to follow financial years, and in most countries, actually, calendar year is financial year, but in India we follow financial year differently from the calendar year. For each financial year, you have balance sheet, income statement, and you have another statement called cash flow statement. We've not looked at the cash flow statement, but after we are done with the first two, we'll go to the third one. The third one is basically a build up upon the first two. So these three statements are going to talk about assets and liabilities of the business, incomes and expenses for the business, and hence the profit. And let me leave this blank for now. So at the end of every year, you can figure out, what is going on in the company. And to top that further, 1 year may be still a long period of time during which frauds can happen, things can go wrong. So the public companies are further expected to divide their financial year into quarters. So you have quarter 1, 2, 3, and 4. So every quarter 1, 2, 3, and 4, every 3 months, the companies are supposed to publish their balance sheet, income statement. They are supposed to report their financials quarterly even, and this is for public companies which are listed, companies in which general public has invested their money. So that's accounting period concept. You need to review the performance of the business, and you do that periodically. Those periods are financial years, and we call them accounting periods. So we follow a financial year as an accounting period during which we take care of recording, classifying, and summarizing the transaction. So for every such accounting period that is determined, you could compare year on year over a period of time whether our profits are going up or are we losing money, what is happening in the company. Okay, let's move on. So when you go to the Reliance Industries website under investors financial, we looked at this annual report in the previous videos, but if you notice, you have Q1, Q2, Q3, Q4 financial presentations, financial results as well. Just wanted to show you as a proof of, I'm not just talking out of thin air, but it is actually true. Okay, let's talk about the last principle for this video. It is called cost concept. What does it mean? Now, cost concept means that all the assets which are purchased by the business, and you very well know what assets are, the assets are going to be recorded at their cost price. Their cost price. Now, the question is, if not cost price, what else? Is there another price which can be there? Well, yes, there can be another price which can be a market price. Now, what is this market price? Let's compare these two. Let us say 2015, you purchased an asset, let's say it's a building, and you paid, let's say, 100 units of money for it in 2015. And we are in 2020. Now, at this point in time, if you want to sell off this building, you could make, let's say, 120 units of money, 120 rupees. Okay. Now, this is the market value. This is market value, and this is the cost price. Now, what happens during 2016, 17, 18 and 19? There are, number of accounting periods in between. Now, I'm referring to the previous principle of accounting periods. So there are 1, 2, 3, 4 and 5 accounting periods which have lapsed during this time. So what happens? Now this 100 was used for one accounting period. Its value has to come down because there is regular wear and tear, all of that. So there has to be a reduction. Let's agree on a 10% reduction in the value of the building. So you would have a reduction of 10. Therefore, the value is going to be 90. In the following year, again, you have, say, another reduction. Let's say, let's assume equal reduction. So you have, let's say, 10 and let me write 80 here, another reduction. Again, in 2018, you have a reduction of 10 and the value is 70. And finally, reduction of 10, you have 60, another one actually. So another reduction here and the value of the building in 2020 is equal to 50. These 10s that I'm deducting, 1, 2, 3, 4, 5 time periods, 1, 2, 3, 4 and 5. For 5 time periods, every year we are reducing the value of building. Therefore, the current book value, this is the book value meaning in the books of accounts, the value of the building was 100 to begin with, which was cost price. And now it is 50 currently, which is book value. And every year we charged these 10 as depreciation. When I say charged, I mean, deducted. Charged is a typical word which we use while recording the transaction in the books of accounts. You will get familiar to it. So 10 rupees as depreciation is being charged. And then every year, you have a book value, new book value for the building. Okay. So every year we are going to say in 2016, we are going to say 100 was the cost price and depreciation was 10. So cost price and depreciation. In the following year, we are going to say 100 is the cost price and 20 is the depreciation, and so on. So in the final year, what we're going to say here is 100 is the cost price and 50 is the total depreciation which has been charged. Therefore, the current book value is 50 book value. Just another way another clean way of representing it. So the cost concept, the principle of cost says that you should always show the cost of the asset at which it was purchased and you show the total accumulated depreciation along with it. Okay. Now let me come to the market value. In 2020, if you were going to sell the building at 120, now what should be written in the books of accounts? Till the time you have not sold the building at 120 rupees, this 120 does not exist in the books of accounts. It is a notional value. It is a future value. When you sell it, then you will get that money. All right. So the market value actually has no place in the books of accounts as far as recording for assets is concerned. So I'm going to write we do not record market value of assets. We only record the cost price, the book value of the assets. Now, if you sell, however, if you sell an asset and realize, by realize I mean you receive the money, you realize the 120, sorry, which is the market value, then suddenly what happens, you write in the books of account that you have sold the asset. You have sold the asset for 120. The book value was 50, and you have made a profit on sale of asset, right? And now you're going to show it. Now it is no longer a book value, it's an actually value. It's no longer a market value, it's now an actual value which you have received. So you show a profit on sale, asset has been sold, compared to the book value, you make a profit. And if you remember from the previous videos, profit on sale is an income for the business, but it's a non-operating income. We did not set up the business to sell our assets, but it's once in a while thing, right? So that is cost concept for you. Quickly, another exhibit for you, which shows, again, this is from page number 274 of Reliance Industry Limited's annual report. It says property, plant and equipment are stated at cost. If you look at any annual report, they will show you what are the policies, what are the principles that they have followed. And this is that section where they say the assets have been stated at cost. And then, accumulated depreciation. Accumulated depreciation refers to this 50. This is the accumulated, cumulative depreciation over a period of time, and any other losses. So there are some other advanced items as well, but I wanted to show you only this point, that the companies have to report in their annual statement that they are following the cost principle and actually other principles as well. So I showed you this earlier as well. So you have the cost price of the gross block here, then there is total accumulated depreciation till date, and this is the net block. This is how the details are shown. So there you go. In this video, we discussed the 5 accounting principles, the ground rules using which the financial statements are prepared, transactions are recorded. I'll see you in the next video.